Hi folks, Scott here, and this is the wrap for Tuesday, June 4th. So this is the recent action on the S&P 500 futures. If you look at the spider, it's going to look almost identical. Actually, if you look at any of the U.S. indices, they're going to look somewhat similar because all highly correlated. But what I want to show you going into tomorrow are the results of fading gaps after this somewhat unique two-day pattern. And I'm defining this pattern as a bearish engulfing pattern. There are different ways you can define that fairly well-known term, but I'm simply defining it as opening above the close of a green candlestick of a prior session and closing below the open of that same green candlestick. So a red candle that engulfs the body of a green candle, not looking at the wicks at all, just an engulfing pattern like this, and with additional consideration of being below the 10-day moving average, which is the yellow or gold line, and above the 200, which is way down here somewhere. There it is. Above 200. So fading gaps after a bearish engulfing candlestick when below the 10 and above a 200-day moving average. I'll use Gap Trader, my back testing tool, with an end of day stop. And there you go. A couple of things stand out. 3-to-1 odds on gapping up the next day. Now this is a small sample size, so not as statistically reliable, but it does meet the minimum n equals 30 for you statisticians or folks that remember you took a stats class in college or in grad school. N equals 30 generally means it's a meets the bare minimum of robustness, if you will. So 3-to-1 odds of gapping up, and the data is pretty lopsided too. When it's about 50-50 in terms of which days a market will gap most of the time. So odds favor a gap up. That's the key takeaway. Second takeaway, you can't really see it here, but this data is a little bit. Well, actually, you can't see it. Both these win rates are a little bit weaker than average, which is 70%, but sample size is so small, I discount it. And they both have, the down gaps have made money is probably pretty much one trade. Yep, one trade here. See the profit from one trade, 10 contracts. So you can't read into that. I don't always know the numbers of how this strategy performs using our MTG stop parameters, but let me just show you real quickly. We'll format to use what we use for an intraday stop here at Match the Gap. That's equal to 30% of a 5-day average true range. ATR length is set to 5 right there. I've set this to 3. And for the ES, I use a maximum of 12 points, a minimum of 5 points. Just better manage my risk. And watch this number in particular. So we have 15 wins, meaning the 15 gaps that filled or finished profitable by the end of the day for up gaps. You lose 3 of them, though, with our MTG stops. So on a small sample size, it doesn't take much to throw these numbers off, but it does show you that it's only a 50-50 trade in terms of whether you would capture gap fill or be stopped out. So no edge to the short side. Now this is one study. As always, I will defer to our gap guides and my other thorough analysis I conduct each morning before I make a decision. But on the surface, the one thing we can say for clear is that this particular pattern favors a gap up, and a gap up's only been 50-50. And that's even more interesting when you consider the fact that tomorrow is the 5th of the month, the 5th trading day of the month. And this is another little bit of a I don't know if you call it a nuance or what. It's hard to describe or explain why it's been this way, but it's been fairly consistent. The 5th of the month just tends to be a risky day for shorting up gaps. Tends to be a bullish day, I guess, because the markets tend to get overbought going into the end of the month and the beginning of a month. Then maybe they pull back a little bit and they have one more thrust higher by the bulls on or about the 5th of the month. So that could happen tomorrow. That fits with the recent pullback we've had. So I think a gap up, we'll see, but could be a little riskier than normal. We'll see what the gap guides say again before I make my final decision. But there's some thoughts going into tomorrow. Now let me show you. Let's see. We'll look at the worksheet today. Pretty interesting setup. If we gapped above the highs, which the NASDAQ did today, historically this was a 50-50 win rate and a profit factor less than 1 means it's been a money loser. This assumes, this is the average of our 8 indices and assumes MTG stop parameters. So gapping up above the high is not attractive. Gapping between the prior high and the prior close, which is what the majority of the indices did today, even though somewhat barely, really strong numbers. 75% win rate, 1.6 profit factor. Huge delineation there, right? Big delta between just all because of where the markets opened historically relative to the prior highs. So for me, that was a little bit concerning if we opened near the highs, which is what we did in the ES. Let's see. neutral and up gap in terms of unique patterns. Last night's analysis showed 10-day low that was not a 10-day low close, 50-50 trade as well. That was an accident last night. I made a mistake. That was inclusive of a 10 a.m. time stop. So when I changed it to end of day stop, it went to 50-50. It wasn't quite as bad. Still not good though. And then see, June didn't really shed much light on the subject, even though being below the 20 has been a positive story, below the 20-day moving average and above the 200. See, the numbers are a little bit better. So small ranges, a little bit tough to see where we're going to open today. And bottom line is only the UHC zone was attractive. Everything else was a little bit mixed. And the big problem, in addition to, which I didn't mention here, but just common sense, I think I may mention our helpful tips here too, proximity to another much lower probability area was a concern for mine. I didn't know where we were going to open, but I'm just telling you that is something I explained in our trading room, as was closing variance. Yesterday, the ES, S&P 500 futures, closed at 1636 roughly, but at 4 p.m., 15 minutes earlier, they were trading around 1638. That's more than a 2-point variance. And in this case, resulted in, or could have resulted in, a down gap in the ETFs, but an up gap, correction, a down gap in the, no, that said that right, a down gap in the ETFs like the spider, but an up gap in the futures. So that's what this was talking about here. And with small gaps, my criteria are more stringent. So generally don't trade mixed opening directions. So what that really left us with, by the way, there's some nuances in play. If I'm totally confusing you, just close the video and come back another day. There were several nuances today. Actually, let me get over here, 5-minute chart. Break it down a little bit further for you. See the white line just barely underneath the green line. The green line was 1639. That was the highs from Monday. We opened just underneath it. Blue line is a prior close there. And then we ran all the way up to 1644. So I would have been stopped out using a 6.25 point stop per guide. So good decision to not fade the gap. But here's what I want you to be clear about. That technically was a gap up in most of the indices. Let's look at the ETFs. We did not open in that 2-point window just above gap fill. See, in fact, you look right there. The 4 p.m. close is that gold bar right there. It was about right there, just below. It's hard to tell, but just below where we opened today. So had we gapped down, the ETFs, which opened basically flat or up a little bit, would have gapped down. In fact, it looks like the Russell opened flat. NASDAQ gapped up. Oh, the Dow did open down. So it's just a crude assessment to avoid mixed opening directions. The problem is, on a small gap up, you're looking to fade it. Well, you don't want to be fighting other indices that may be gapping down. You know, they'll be trading the other direction, providing counter pressure to the trade you're in. So for me, there was a tiny window where we wouldn't have mixed opening directions in the ES, but we had the NASDAQ gapping up, and we were opening in close proximity to a terrible zone, the UH zone today, so I passed. That was a good decision. 15-minute and first-hour range guides came out. Slightly favored the high breakout, which would have been a loser in the ES. Let's see. And I'm not sure about the NASDAQ on the 15-minute, but would have been a loser on the first hour. But winners on the low side. The low sides were slightly favored also. I didn't think anything was too very compelling. A little bit of an unstable setup, 10-day low with a small consolidation day. Could go either way today. So I just decided to sit on my hands. That ended up being a good decision. I did miss the sell-off, but that's fine. You know, some days are just no clear historical edge and not worth trading. So that was my quiet day, and we'll see what tomorrow brings us. So there you go. That is the wrap for Tuesday, June 4th. Have a good one.